This video is brought to you by 8% Value Activist Substack newsletter. Today we hope to do a back to basics, recap fundamental post. But first, let's go through the disclaimer. I have to point out that my voice is AI generated because the author's original voice put sentient beings to sleep. The rest of the disclaimer is about copyright, and what's here is not investment advice, and so on and so forth. Please take some time to read through it. Thanks. Okay, let's start with the overview. What is FCF? FCF stands for free cash flow. It is an entry in the financial statements like earnings per share or EPS, but much better. EPS has been around for 100 years, and CFOs have found ways to generate EPS and beat analysts' estimates quarter by quarter. But free cash flow, or FCF, is derived from the cash flow statement and actual cash movements. It is less easily manipulated, for the lack of a better word. Over time, free cash flow should equal net income, and we shall discuss that later. Lastly, we will also talk about free cash flow as a valuation methodology. Okay, this is the real meat of the presentation. We will walk through an actual cash flow statement to calculate the free cash flow. On the right is Viacom's cash flow statement. Viacom is a Singapore emission testing company. The cash flow statement starts with net income at the top. That's highlighted in the yellow box. It goes through a bunch of stuff to get to what is called the operating cash flow or cash flow from operations, or OCF. That's the orange box. In between, there are many things, but what is important is depreciation. The rest of the stuff usually cancels out one another over time. Let's remember depreciation is important. We will come back to it. So now we know what's operating cash flow. It is basically net income plus depreciation plus a bunch of stuff that cancels one another out. And free cash flow is basically operating cash flow minus CAPEX. What is CAPEX? CAPEX stands for capital expenditure. CAPEX is the investments required to keep the business going, like investing in equipment or software. So free cash flow, which is essentially net operating cash flow minus CAPEX, represents free cash that can be returned to investors or debtors at the end of the day. That's why we want to focus on it. Okay, this is what's interesting. Recall that depreciation is what is important. Now, depreciation is actually CAPEX smoothened out over time. For example, an airline buys airplanes year 1, depreciates it over 10 years, then buy new planes in year 11. So over time, CAPEX equals depreciation. On the bottom right, we wrote down the relationships between net income, operating cash flow, depreciation, CAPEX, and free cash flow. So we can now see that free cash flow should approximate net income over time. Next, we want to show you why free cash flow is more superior metric. On the left, we have Viacom's free cash flow, in blue, net income, in purple, and equity, in orange. On the right, we have Evergrande's, in the same colors. Evergrande was one of China's largest property developer. It went bankrupt. You can see that while Viacom's free cash flow approximates net income and equity was stable, Evergrande numbers were all over the place. Evergrande showed improvement in net income and equity year over year, but free cash flow was actually negative most of the time. In 2021, Evergrande's equity became negative. So technically, it was already bankrupted back then. So you see, tracking free cash flow is important. And hopefully, this evidenced how free cash flow is very robust, much better than earnings per share. Over here, we want to discuss free cash flow in the bigger scheme of things. Since 8% Value Activist talks about shareholder activism, we wish to highlight that activists target businesses that can generate free cash flow, because they are in the companies for the long haul, usually a few years, sometimes as long as 10 years. Activists want to effect changes by joining the board of directors, advising the company on growth and M&A, and at times, spinning off businesses. These take time, and if the company has no free cash flow, it doesn't work. It is also important to compare free cash flow to revenue, margins, and that of peers. Then we know whether the company is performing to its potential. That's what activists will focus on as well. In the columns highlighted in red, we wanted to show what is called the free cash flow yield. It is the free cash flow, dividend by market cap, and it is a valuation metric like price earnings or EV over EBITDA. The higher the yield, the cheaper the company. Activists also tend to look for cheap companies trading. As such, activists are also value investors. Take the case of Viacom. Its free cash flow yield is 5.9%, which is pretty high, but it is actually lower than the peer group's average. However, we know that Viacom's free cash flow had been stable and therefore more sustainable, but we are not sure about its peers. So, in that sense, we can say that Viacom is not expensive, but is fairly valued. If we look at enterprise value or EV divided by free cash flow, that might tell a different story. EV is essentially market cap plus debt, so a company with no debt would look cheaper on EV divided by FCF. Viacom might look cheaper on this metric. Now, what if free cash flow yield is very high, like 15% and sustainable? This is a hypothetical question because such companies rarely exist. The answer is that we do not need the company to be listed. The owner should privatize it and enjoy the 15% cash coming out of the company every year. Okay, this is the last slide. Conclusions. We learned that free cash flow is a superior metric. It demonstrates the cash generation capability of the business. And activists tend to look for businesses that can generate free cash flow. Free cash flow is not easily manipulated, and over time, it should approximate net income. It can be used as a valuation metric. The higher the free cash flow yield, the better. We hope you enjoyed this video. Please subscribe to our Substack and this channel. Follow us on social media. We will be discussing more activist stuff in the days ahead.